السلام عليكم.
وعليكم السلام ورحمة الله وبركاته. We are live online.
Let's wait for a couple of minutes for a few more
People are
members.
asking, people are asking when we can start. So I just answered the question. I said we will be starting in a few minutes, inshallah.
Oh,
Assalamu alaikum, Brother Zafir Iqbal. Thank you for your comment. Again, we will be starting just in 1 minute, few minutes, inshallah. I can see a screen blocking the view in the middle. Is it part of the presentation or?
Brother Matt, I can also see that. I think either somebody else is trying to share again also, or
It's
yeah.
solved. It's solved now. Yeah. Okay. Yes. Now it's okay. Asfar Iqbal. Thank you, brother. Brother Omar, can we start? Shall we?
Yes, I think we should start, Brother Maj.
Okay. Bismillah ar-Rahman ar-Rahim. Alhamdulillah Rabbil Alameen. بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. Ladies and gentlemen, distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. It gives us great pleasure and honor to welcome all of you to this public hearing event, which constitutes an advanced interaction stage with the Islamic finance industry and the broader circles of stakeholders, being the second leg in a series of public hearings for the newly issued exposure draft entitled Participatory Ventures, with a particular aim to reach out to subject matter experts and practitioners worldwide, where their comments and views can be raised, discussed, and then compiled and submitted to the respective working group for its consideration and submission to the IOFI Accounting Board for its review and approval for issuance as a final standard. These standards prescribe accounting and financial reporting principles for recognition, measurement, presentation, disclosures applicable to participatory ventures, including most of the common structures and products that have mudaraba and musharaka as an underlying contract. More specifically, this standard is applicable to financial accounting, financial reporting by the investors, investors, the working partner or partners, as well as the participatory ventures in relation to all such participatory ventures that are covered within the scope of this standard. This includes ventures with fixed and variable equity and quasi-equity shares. The public hearing today is conducted live via video conferencing, and participants join us from different time zones worldwide. So we would like to welcome you again, and we really appreciate your interest and keenness to join us in this special event. Today's session is being conducted with support from Bahrain Association of Banks, BAB, and here a word of thanks and appreciation goes to them for their support and for their active part in today's session. Ladies and gentlemen, distinguished guests, dear brothers and sisters, I'm pleased to invite to the virtual floor Mr. Omar Mustafa Ansari, IOFI Secretary General, to present the exposure draft and walk you through its main content while interactively answering your questions and addressing your comments. All relevant comments, as I mentioned, and suggestions will be collected and presented to the respective working group to consider and make changes it deems appropriate to the exposure draft before submission after completion of all the legs of the public hearings to IOFI Accounting Board for its further review and issuance of the final standard. Brother Mr. Mustafa Omar Ansari, over to you, sir. Brother, you are mute. You are mute. You are still mute.
Can you hear me?
Now, yes. Now, yes.
Okay, thank you very much.
Pleasure.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Thank you, Brother Majd, for the introductory remarks, and thanks to all the participants for being here with us. The standard that we are going to discuss today is one of one of the core core elements of Islamic finance. Rather, a lot of experts and a lot of scholars and economists say that Islamic finance is all about participation. So here we are talking about some of the fundamental products and structures that are the real essence, the real core of Islamic finance. While we can understand that the practical use of these products in the Islamic finance industry at present, due to maybe the mindset issue, due to maybe the regulatory challenges, maybe due to the business challenges, the overall environment, there can be arguments on that part. But the reality is that if you do not focus on these products, the real benefits of Islamic finance cannot be reaped. Before going to the standard itself, I would like to touch upon some of the aspects with regard to the significance of these products that we are talking about, participatory products, Musharka and Mudarba based in particular, where the the approach of the Islamic finance industry today might not be focused towards that, but at the same time, the founders and initiators of Islamic number 3 and 4. So effectively, the first standard was on the general presentation of financial statements, which we revised recently. The second standard was on Murabaha. Obviously, we can well understand the Murabaha. We are talking about the real Murabaha. We're not talking about the commodity Murabaha or the Tawarruk. But the Murabaha standard was the second standard. And standard number 3 and 4 were on Mudarba and Musharka, which are the ones that we are revising in form of this standard and combining them in one standard. Before going to the standard itself, I would, as I mentioned, I would like to touch upon some of the key aspects with regard to Musharka and Mudarba, and I would like to address this issue a little bit, that Islamic finance is not giving enough focus on that those structures, that avenue of participation, which is one of the main hurdles towards the achievement of the real benefits of Islamic finance. When we talk about Islamic finance in theory, we say it's about risk sharing. We say about that this is to enhance the real economic development. It is to support the real business activity. It is there to support entrepreneurship development. It is there to support the equitable distribution of wealth within society. That your wealth should not be circulated amongst the wealthiest of yourself. This common argument against Islamic finance that we are having on an ongoing basis is something that haunts us. Some of the experts of Islamic finance who have been trying to understand this industry, work for this industry, support and foster this industry for maybe again, I would say that for me, it's now nearly 3 decades, that to some extent I have particularly for the initial involvement, which was limited. But this thing haunts me, and I can tell you that it haunts a lot of our scholars, economists, and experts of Islamic finance, and it haunts a common man. And I can see that I have heard some of the central bank governors, I have heard some of the international multilateral bodies, experts. I have learned from the economists and experts from Islamic Development Bank and others that whenever we talk about Islamic finance, somehow we see that the banking sector is just trying to mimic the conventional banking transactions and is not trying to really explore the realities of Islamic finance, which include obviously the participatory ventures. Whenever I'm saying that the enough focus is not there, I don't want to say that, okay, Islamic finance is all about participatory ventures. No, Islamic finance is about whatever is permissible by Sharia. But we all understand that something that is permissible by Sharia versus something that is preferred by Sharia are two different things. Something that is desire of Sharia, something that is the eventual objective of Islamic economic and financial system, and something that is merely permissible are two different things. And to some extent, I know that a lot of people argue, with UFI, that UFI is not giving enough way of innovation. The problem is, to some extent, we are feeling now that all the innovation that we are talking about is just mimicking more and more conventional products. We are not talking about what is actually innovation, what is actually different. In my initial years of training, I used to ask a question a lot to my trainees. And let me put that question to all of you again. The biggest argument that we feel that people say, oh, there will be losses in Musharka, there will be like, there is a huge risk of loss and all that. Okay, regulatory issues we know, and I'll come back to them later. But with regard to the fundamental part, that there will be losses and who is going to absorb those losses and who is going to take responsibility of those losses that happen in case of Musharka and Mudarba. My question used to be to the whole class, and that I put in front of you as well. What is the probability that a reasonably good selected and diversified portfolio of investments in different businesses will eventually have a net loss in a long term? This is my question, and let me add one more thing to that. While exercising good governance practices, I just added good governance and risk management practices. So the question would now look like, after adding this part of the question that recently I thought I should be adding to my question. So the question after adding this would be, what is the probability that a reasonably selected, diversified portfolio of investments in different businesses will have a net loss in the long run if good governance practices and risk management practices are exercised? I would like to humbly submit, and I can see some of our very good friends putting some answers here. Brother Asfar Iqbal says that very less chances. Brother Latif Oilan says that 0% chance. So the question is, the net loss is just a probability, Brother Abdul Aziz Fall says. So the question is, we are not asking you to do just one big muraba with one product, one transaction, and just try to do something which is, how to put it, that you just go for one single venture. No, we are not asking you to put all the money in one place. We are simply saying that if you have an appropriate portfolio of Musharka and Mudarba based participatory ventures in which you invest on a prudent basis after careful selection, after appropriate diversification of businesses and geographies and whatever is needed, and after applying good governance and risk management practices, the probability would be very close to zero. Okay, let me put another question. There are different types of financial institutions. So there are business investors who invest in retail banks. There are investors who work with investment banks. There are investors who work with private equity and venture capital. And there are investors who go for speculations and derivatives and speculative investments in stock markets. Who make the most of the money? You establish a bank, you cannot become Warren Buffett. Just try to understand that this whole structure of financial system favors those who take appropriate risk. And the reality is that retail banks earn the minimum, investment banks earn more than them, in terms of capital, return on capital. Venture capital and private equity earn by far more, and stock market investors who do the right calculation earn the most. So this paradigm that there will be losses is a mindset issue. Islamic finance is not about just mimicking conventional finance. Islamic bank is not just a sort of say Sharia compliant replica of conventional bank. And from that perspective, it is very, very important that you need to do this thing. And Islamic banks, when we talk about Islamic banks, even on the liability side in form of quasi-equity, you have appropriate risk absorbing tools available. So the whole effect does not come on the capital, rather it is distributed. And nobody is asking you to put all the money in one product only. No, you need to apply the right risk management policies and governance practices. But the point is that we believe that Islamic finance need to appropriately focus on the real products of Islamic finance, which include the participatory ventures in particular. After this sort of I would say that it was my preamble about the need and significance of participatory ventures. Again, we can take, if anybody has a question here, we can take this any question at this stage. And as we always request, please put your questions and comments in the Q&A tab, please. However, with this, we try to move now to the standard today. We believe that in order to promote the equity-based financing and the participatory financing and participatory investments, AOP need to work more towards the standard development on that area. Phase 3 and Phase 4 that were developed in the initial phases of AOP, early 90s, they had become quite old by now. And they were needed to be aligned with the new Phase 1, new framework, some of the new requirements of IFRS. These were, it was important to consider some of the new products that are there, like running Musharaka product or some other product structures. It was also important that the sukuk which are based on Musharaka and Mudarba, particularly Mudarba, their back-end accounting needs to be improved, including the underlying assets accounting. Similarly, the underlying assets accounting and the subsequent measurement part was not very well defined. We did not change anything fundamentally, but we tried to improve all these things. And we try to bring the standard as a combined standard, as a single standard, closer to what the new AOP standards and new IFRS are. Obviously, the difference with conventional instruments will remain there, that IFRS or other conventional standards generally consider these as financial instrument, and the subsequent measurement and other accounting treatments might still be different, because we as AOP first ensure Sharia compliance, and secondly, we ensure that the true nature of the business and the venture is reflected, the true nature of the transaction is reflected. So from consideration of that perspective, this standard is a significant improvement against the previous standard. So here I will share my screen for the standard. As we always mention that this is not a separate presentation, it is merely a PDF or a PowerPoint version of the same document, which is available to all of you in form of PDF. Let me quickly take you through the significant changes section. The first one is that existing standards did not cover the cases of participatory ventures in the books of account of the working partner and the participatory venture itself. So they were talking about how the investor does the accounting, that is the bank who is providing the finance to on the Musharaka investment on Musharaka or Mudarba basis. Actually, the earlier standard was using the term financing, and due to the true nature, we are trying to put it as investment rather than financing. Participatory ventures, subsequent measurement is dependent on the accounting of the underlying assets, that is the participatory venture accounting itself, and that is what we have covered in this standard. Secondly, we have covered the accounting by the working partner as well. So this standard enhances significantly the scope and details of the accounting aspects that have been covered. The existing standards were not aligned with the conceptual framework and the generally accepted accounting principles in many aspects, including establishment of control, quasi-equity, and off-balance sheet accounting. Rather much, no comma before end. Specific cases of participatory venture with gradual transfer of ownership or transfer of units, such as variable equity ventures, for example, running musharaka, diminishing musharaka, and restricted musharaka mudarba, were not covered under the existing standards. The existing standards are similar to other earlier phases issued by FE, including certain Sharia-related requirements in the body text as well as in the respective appendices. In line with the newer AOP phases, the requirement have been removed, and this new standard refers to and shall will be read in conjunction with the respective AOP Sharia standards. So this is the summary of the significant changes, although the significant changes are quite detailed. In the Q&A tab, there is a comment from an anonymous attendee. Always we request that please put your name so that the comments are recorded with your kind name. So please, just a request to everybody who has joined it as anonymous or without mentioning the name, that please mention your names you can always rename yourself in Zoom so that your name is there and the comment is recorded with your name. In Western world and modern day banking, credit creation out of thin air is primarily form of capital used to leverage such investments in venture transactions. This is a comment. Partially, I would say that I would before I make any comment, I would love to learn a bit more about the comment that what you want to what you want to conclude out of this comment. That what is your conclusion of this situation that you are mentioning. So for me, I would say financing under a profit and loss mode is not creation. That is my quick comment on this one, but I would love to learn more about this comment. You can put your comment a bit more in detail, and with kind request again that kindly put your name as well. So once you explain it further, we can discuss your comment here again. Thank you very much. Okay, so objective of the standard. The objective of the standard is to prescribe the principles of accounting and financial reporting for the participatory ventures. The scope includes, there are scope exclusion as well in paragraph 3, but it applies to all participatory ventures. And the definition, we'll go to the definition of participatory venture. Let me go to the definition of participatory venture first. Participatory venture is participatory structure is defined. Let me go to participatory venture. Okay. Just one thing, Brother Maj, I think we decided about, there is a question that we need to put to the public hearing as well. During the development of the standard, there was a term used, Sharia compliant participatory venture. And then at one stage, it was decided to keep it only participatory venture because AOP works mainly for participatory venture only. So technically, the question to the participants is, do you feel that participatory venture, when we use in the context of AOP standard, includes the connotation that it is understood to be Sharia compliant, or it would be more appropriate to use the term Sharia compliant participatory venture or SCPV as a short form? So that is one question that, because it was discussed in the working group and board, would like to ask you that, do you well understand the term participatory venture, and do you well understand that when in the context of AOP standard we are talking, it includes only Sharia compliant participatory ventures? One thing to mention, that it is quite possible that a venture is not called a musharaka or mudarba by its name, but it has the characteristics of a participatory venture, and it has no Sharia non-compliant element in it. So even if it is not called a partnership or it's not called a mudarba or musharaka or shirka or any other specific form or no specific Sharia compliant conditions are attached to it, but it does not include any non-Sharia compliant conditions. So it may still be a participatory venture, even if it is not called a musharaka or mudarba. Another question was that in the Sharia committee, it was discussed that it might still be more relevant to the market that in the name of the standard, musharaka and mudarba is mentioned. So one option is that we call it musharaka and mudarba accounting, which personally, like the way standard is drafted, is combining the characteristics, so it won't be appropriate. But another option is we call it participatory ventures, colon or hyphen musharaka and mudarba, or musharaka and mudarba, and can be in brackets. So the question that we are posing to the participants is, number one, about the name of the standard, whether it is necessary to have musharaka or mudarba in the name, or you feel that it is understood. Number two, would it be more appropriate to use the term Sharia compliant participatory ventures, or using the term participatory ventures would be sufficient, and given that in AOP, the scope is primarily only the Sharia compliant transactions. So we can take questions on that, or what do you suggest, Brother Mas? Shall we have a poll on that?
Yes, we can have two polls if you like.
Okay, let's consider taking a poll later. But at this point of time, if we can
And listen
have
to the
some
comments
from the participants, that if they generally feel that this is enough or not. Brother Maj, with regard to the participatory ventures versus participatory structures, we need to see the terminology because a couple of places we need to align it. Secondly, paragraph 4D, there is an extra space there that needs to be removed. Just note it down. Okay. The standard shall not apply to the following: investment accounts and similar participatory instruments issued by IFIs, Islamic banks, and other IFIs, which are subject to requirement of relevant UFI phases, that is the quasi-equity standard and the off-balance sheet asset under management standard, which are already issued by UFI. So the Islamic banks, quasi-equity side or the off-balance sheet statement side, these are not covered in this standard because there is a specific standard available on that area. So who will apply this one? Primarily, the bank will apply it on the asset side. The bank's counterparty will apply it on the liability or quasi-equity side, and it will be applied for doing the accounting for the underlying assets themselves, or underlying asset or business venture, whatever it is. The investment pool accounting is also defined in the respective standard, so that will also not be covered here. So technically, bank's asset side and the counterparty equity or quasi-equity side will be like the one where you apply this one. Again, if UFI standards are primarily applicable on Islamic financial institutions and Islamic finance transactions, but in certain countries where where our standards are adopted, these are not adopted for the counterparty. That is one thing that we have to work with regulators to convince them that the counterparty accounting also need to be taken from the UFI standards. But at our end, we need to define both of the counterparty accounting, particularly because at times the counterparty is an Islamic financial institution itself. So, for example, there can be a Islamic bank that has a participatory venture with an Islamic fintech company or a takaful company, etc. There is one more thing that we need to understand here, that the participatory venture accounting would be applicable on Sukuk also. Sukuk exposure draft of FAS 29 says that the primary classification and characteristics, presentation and classification and characteristics and disclosure, they are defined in FAS 29, which is not yet final, which is an exposure draft stage. that respective standard, that's FAS 29, it mentions that accounting of the back-end assets or the transaction structure should be done in accordance with the requirements of relevant AOP FAS, which means that if there is a Mudarba or Musharaka structure-based sukuk, the back-end accounting of that will also be done under this one. So, for example, there is a company, corporate entity that issues a Musharaka sukuk or a Mudarba sukuk, that will apply FAS 29 with regard to the disclosures and presentation, and it will apply this standard for the accounting of the back-end assets. Investment accounts and investment agency, Wakala bil Istismar will not be covered here because that is already covered in FAS 31. Co-owned assets based on Shirkatul Milk. So in some of the markets, including Pakistan, South Africa, UK, some other countries, we have a product of Oman. We have a product called diminishing musharaka, which is based on Shirkatul Milk, which is the combination of co-ownership and ijara. That one is covered by AOP in ijara standard as a gradual transfer ownership ijara. So that one goes to FAS 32, so that one will not be covered here. So diminishing musharaka term used in this standard should not be confused with the more common diminishing musharaka in certain countries, which is diminishing musharaka based on Shirkatul Milk. Pakistan, Afghanistan, Oman, South Africa, UK, I think a couple of other countries, they have that diminishing musharaka as a very common product. In some other countries also similar product is there which we call gradual transfer ijara. So either of the two are covered in FAS 32. Here when we talk about diminishing musharaka, we are talking about a contractual partnership, that is Shirkatul Am. I can see one comment coming on, Brother Asfar Iqbal. Musharaka and Mudarba accounting looks better. Thank you very much, Brother Asfar. We will note it down. But here the question is, Mudarba and Musharaka and Mudarba accounting, if we put it like this, the problem would be that earlier standards were having two different standards and only a couple of paragraphs were different. That was the reason that we wanted to come up with one single term, Brother Asfar. Otherwise, you end up having two standards having 90% of the content similar. So, or otherwise, every time we start saying Mudarba or Musharaka venture, so this is not only about the name of the standard, this is also about the common term that can be used for both. So what will happen, we'll start saying Musharaka and Mudarba working partner, Musharaka and Mudarba investor, Musharaka and Mudarba venture. Just think of it, because 90% of the treatments remain the same and technically Mudarba, Musharaka both are types of partnership. Only some of the Sharia conditions become different and the profit and loss distribution mechanism between the two becomes different. Other than that, the underlying asset accounting, the profit and loss accounting, the classification, risk factors, most of the things remain the same. So thank you very much for your kind comment. We take a note of this one as a comment. We'll take it to the committee, but putting a name like this, which was discussed earlier in the account working group and the board, and was rejected because of complications that would come in the use of the term as a use of a single term in the whole of the standard. Thank you very much, Brother Asfar, again. Okay, participants investment fund and other similar participant instruments issued by the Kafal institution to the Kafal participants which are subject to the requirement of relevant UFI phases. So we have our FAS 42 and FAS 43 addressing those. So participant investment fund and some other similar instruments can be considered technically as Musharaka and Mudarba ventures, but this is at times subject to very specific accounting requirements. So they are not subject to this standard, but rather they are subject to the requirements of FAS 42 and 43. Investment structures in the form of a legal entity. So now let me clarify one thing. This applies when you do not form a legal entity. you have a musharaka, mudarba, or other form of participatory venture agreement, but you do not create an entity. So investment is structured in the form of a legal entity, for example, those including issuance of share capital by the working capital, so a working partner. So if the working partner issues share capital, then it will not be subject to this standard, although it is technically a musharaka. Investment in sukuk shares and other similar instruments which are subject to accounting in line with the requirements of relevant phases, except for sukuk based on participatory ventures to the extent of underlying product and asset accounting as referred back to this standard, as I already explained earlier. Investment funds and entities having the status of a legal entity which are subject to financial reporting in line with the requirements of respective UFI. So we have FAS 14, but now, Brother Maj, we need to put the updated number, because the new standard on investment entities, Islamic investment institutions, has been issued recently in December. So, Brother Maj, I think we need to update the number here and update the reference here. So if you create a musharaka, but you give it a legal status through a trust, through a legal entity, through a corporate entity, etc., then in those situations, this standard will not apply. Investment in corporate entities having parent, subsidiary, associate, or joint venture relationship, or investment through trust, which shall be accounted for in line with the relevant UFI phases, that is investment in associates or investment in, or consolidation standard. Okay, so we don't have any comments till now.
There is a question.
Yes, brother.
In the chat box, there is a question.
Okay, just a request. Okay, I'm taking this one from the chat box, but a request again. Please always put these in the Q&A tab, because it's easy to take the questions there. And secondly, we keep a record of all the questions for the purpose of taking them to the working group and the board. Is it mandatory to capital to start musharaka venture in the form of money? This is a general Sharia question. Our Sharia standard says that it has to be it can start with money, or it can start with capital in kind. So accounting standard also considers the capital in kind accounting. However, the Sharia standard says that a current debt cannot be a capital for musharaka. So a debt cannot be a basis for musharaka, but so a receivable or debt cannot be used, but what we call in kind means that it has to be tangible. So any tangible asset can be used. A value need to be assigned. The standard addresses this issue, which will be discussed later. So you can have money or you can have in-kind capital, but you cannot use an existing debt to create musharaka. Thank you very much. And again, I request that put the questions in the Q&A tab, please. Okay, now coming to the definitions. Control is as defined in the control of asset and businesses standard. Brother West, I think we should be providing a footnote of that, because I think it was discussed that some important definition we still need to provide in the footnote, but it will remain as defined there. But maybe still we need to provide a footnote of that. Mudarba is defined in the AOP conceptual framework for financial reporting. Musharaka in the special context of this standard is a partnership based on shirkatullah, whereby two or more parties agree to combine their assets, labor, entrepreneurship, financial commitments, and or goodwill for the purpose of making profit. Participatory structure is as defined in AD of control. Again, I think, Brother Majd, I think we need to provide that. Sharia compliant participatory venture. Okay, Brother Majd, just one thing on this reference. I think I noted this thing in the Sharia committee also, that the reference in the scope of 4D should be 4E. Okay, and there is an extra space here in paragraph 2. That need to be corrected. Okay. Now, Sharia compliant participatory venture, which is the main subject of this standard, is a business venture constituted on the basis of Sharia compliant participatory structure, being a virtual entity but not a legal entity, including musharaka and mudarba or any similar structure creating a Sharia compliant partnership irrespective of the nomenclature. Variable equity participative venture is a type of participative venture in which the respective amount of quasi-equity contributed by the investor as well as the working partner remains variable through ongoing drawdowns and redemptions by the working partner on a very frequent basis, normally subject to maximum limit of such quasi-equity contributed by the investor. Explanation: the most common form of variable equity participative venture is running musharaka, although certain other musharaka-based and mudaraba-based products and instruments may also classify as such. Working partner is a partner in a participative venture principally entitled to manage and or operate such participative venture and who receives equity contributions from the investor. Working partner at times may also commingle its own equity in the participative venture. Explanation: a working partner, depending on the nature of underlying contract, may generally include a mudarib or a musharaka's working partner. Brother, Mat, just make a note of one point. I think I noted it earlier as well that we have not put the definition of, we have put the variable equity, but we have not put the diminishing musharaka. Okay. We just need to check whether we need diminishing musharaka. Okay, thank you. I can now see the polls are online. So first is about the nomenclature, keep it as participatory venture or rename to Sharia compliant participatory ventures. That is the first question. And the second question is keep it as the name of the standard as participatory venture, or we call it participatory venture, musharaka and mudaraba. So these are the questions that are on your screen. You are requested to kindly fill in this one. Okay, I'm again getting some questions in the chat box, and I would like to request again, please put the questions in the Q&A tab. Now I will not take any question in the chat window. Please put them in the Q&A tab if you want us to address the questions. I've requested it several times, so my request again, I will be taking anything in the question and Q&A tab only. So the request is that all of the participants are requested to answer the two questions. Part one, about the name or terminology that we use as participatory venture. And the second, participative venture or Sharia compliant participative venture. And the second one, as whether we keep the name of the standard as it is, that is participative ventures, or change it to participative ventures in bracket musharaka and mudaraba. There is a comment with regard to the sound. Let me just ask if others are also feeling this sound issue, please let me know. Brother Majd, is there a sound issue? Anybody else is also observing it? Okay, let me try to switch over my mic and let's try it.
Brother Omar, there is no sound issue here at our end. We can hear you clearly.
Okay. Okay, if some of the people can listen to me clearly, as I can see in the chat window, then it means that the sound issue is on the hand of our other colleagues. Brother, I can see some of the colleagues mentioning, Brother Majd also clarified. So if the sound issue, again, I can just try to be a bit more like, what we try to be a bit slow in speaking to try to make the sound clear. But I can feel that generally the sound is okay, as I can see with our colleagues, some of them mentioning here. And that's what we can do at this point. Okay, so on the poll, I think can I request all of you to try to conclude the poll as soon as possible. So, Brother Mike, can you check how many people have responded till now to the poll?
Yes, we will check. We'll check.
So far, 41 has responded.
That is 50% of the people have answered. So can we request others to please try to answer the poll? I think we cannot show the results unless the poll is concluded. Okay. In the meanwhile, we move ahead to the next section and we just continue our discussion on the next section. Request again to those who have put their questions in the chat window to please put it in the Q&A tab. I still can't see anything in the Q&A tab. Okay. Accounting and financial reporting approach suitable for participative ventures shall be assessed by determining the extent of control by the investor and the working partner on the participative venture. This is where we align our requirement with the new EOFI standards, with the control definitions and the control standard that we have issued. So this is an alignment effort with phase 1 and the control standard. Control standard has also been finalized after that, randomized. So we need to put updated numbers of all the standards before we finalize this standard. The extent of control over a participative venture and the assets underlying the participative venture, where applicable, shall be assessed in line with the definition of control as per respective EOFI phase. An assessment of the extent of control in line with the requirements of paragraph 5 shall result in one of the following conclusions. Now, let's try to understand, because this is the fundamental of accounting approaches that we need to apply. The first situation is when you conclude that the participatory venture is controlled by the investor. Just for the guidance, I would like to mention that a control standard provides in table 1 or table A, it provides some examples how control is established in different types of investment instruments and participative ventures. So the first situation is where investor controls. The second situation is where the participatory venture controls. Participatory venture is controlled by the working partner. My apologies. The third situation is where is a joint control or a shared control. So situation 1, investor controls. Situation 2, working partner controls. Situation 3, shared or joint control by the investor and the working partner. Now, according to these situations, this standard covers different accounting approaches by the working partner, the investor, as well as the participative venture. Participative venture accounting would generally be normal, but the way it is reflected in the financial statements of the investor and the investee or working partner. Okay, just to clarify one thing, at one point we considered using the term investor and investee, but later we decided that even the investee in some situations can become the investor by commingling the funds, etc. So we decided to use the term investor and working partner. This is also something on which, if you feel there is something confusion, you can provide a comment. Although working partner definition is clear and it clearly mentions and explanations provided that Mudarib is always working partner, and in case of Musharaka, there can be the working partner who is defined as working partner in Musharaka is working partner. Now, these are 3 situations. In these 3 situations, what accounting approach follows? So when investor controls a participatory venture, which means that the working partner does not control the underlying assets. When it will be possible? For example, if there is a restricted mudaraba. So brother Majd and me entered into a restricted mudaraba. I have given 100,000 BD to brother Majd. And I said, brother Majd, you are going to use this 100,000 BD only in stock market investment in this specific portfolio and maybe a couple of sukuk also out of this identified portfolio. Brother Majd has very limited discretion of decision making, and I said I will give you 20% of the profit. Brother Majd does not take the risk of the underlying assets because he is just taking the gain element up to the 20%, but he's not taking the loss element, so he does not control it. Once he does not control it, what happens? That since he does not control, he should not be recording the asset in his books. The assets are mine. He is just managing without taking the risk of loss and without taking the control, because control includes two elements: right to govern and usage of the right to govern in a capacity where you use it for your variable returns. Variable returns include negative and positive both. Only positive variable returns do not count as variable returns. So Brother Mush will record it as off balance sheet. And for me, the primary treatment should be pass through. That I record the asset as my own asset on a pass through approach. However, if the pass through approach is not possible, then we follow the net investment in participative venture accounting approach. Now, net investment, what is how pass through approach is done, how net investment approach is done, we are going to explain it later. But in a nutshell, in pass through, I will record the assets in my books. In net investment account in participative venture basis, I will record the net financial position or including the gain or loss on those assets. This is, I would say, net investment in participative venture accounting approach is simplified equity method of accounting. Means that you record the capital and then you record gains and losses attributable to you, and that is the basis of subsequent measurement. This is the more common approach used throughout this standard. But in this situation where the investor controls, pass-through accounting approach is the primary approach. There are no Q&A in the Q&A tab. Maybe some comments I can see some comments are coming on the chat window. So again, if you are having a question or a comment, please put it in the Q&A tab. Okay. Now coming to the second approach, second situation, where working partner controls the participative venture. What happens? Net working partner controls the because working partner controls the asset will be recorded by the working partner, and working partner will be doing the quasi equity accounting approach similar to the accounting of investment accounts by the Islamic banks and financial institutions. Investor will record net investment in participative venture accounting approach, as I said, simplified equity method of accounting. Third situation, where there is joint control, shared control of the parties. So there is a musharaka in which there is a shared control, or there is a mudaraba in which there is a commingling and some other elements, unrestricted mudaraba with commingling, which creates a shared control situation. In that situation, we go for net investment in participative venture accounting approach and net investment in participative venture accounting approach by the working partner also. This is the situation where, as I mentioned earlier, that in some situations we believe that investee becomes investor also. So that is the reason that we have said that he will also follow the net investment in participative venture accounting approach. Now, why net investment in participative venture accounting approach is different from equity method approach, equity accounting approach? Why we did not use the equity method of accounting here? Because equity method of accounting normally applies in proportion of capital only. Means that if I have an associate, the percentage of profit will be coming as a percent, profit or loss will be coming as a percentage of capital held. While here the profit and loss sharing formulas can be different as per Sharia, in line with Sharia. So accordingly, we use this net investment in participatory venture accounting approach, which is similar to equity method of accounting, but takes into consideration the profit and loss distribution formula that is agreed between the parties. Now, another situation, fourth situation, perpetual participatory venture. Perpetual means that there is no end date, there is no liquidation date, and there is no option in the hand of the investor to withdraw the money. Which means that me and Brother Mush created a perpetual venture where there is no conclusion date, and I do not have an option to ask Brother Mush to pay back my money. This is, for example, some musharaka sukuk which are not having a put option. At times they are perpetual, and at times they are perpetual or convertible into the common share capital. If there is a participatory venture which is perpetual in nature, which means that any of the partners does not have a, particularly the investor does not have a put option, that investor cannot go to the working partner and say, give me back my money. That is the situation where the investor will be doing net investment in participatory venture accounting approach, but the working partner will be following quasi-equity accounting approach, but will be classifying it as equity. Because quasi-equity and equity, what is the difference between quasi-equity and equity is that quasi-equity has a put option in the hand of the investor. So in the hand of the investor, if there is no put option, then quasi-equity does not apply. So it becomes equivalent to equity, classified as equity, but for the purpose of computation, some similarities with quasi-equity approach will be there, except for classification, because there is no put option. Participatory ventures involving gradual transfer of ownership, that is diminishing musharaka, or a mudaraba structure having a diminishing approach. Accounting treatment by the investor, net investment in participatory venture accounting approach, if pass-through accounting approach is impracticable. And quasi-equity accounting approach by the working partner. So the working partner quasi-equity approach is always clear, but accounting by investor, net investment in participatory venture approach, Brother Much, here we just need to recheck if pass-through accounting approach is impracticable in case of restricted. If it is unrestricted, then pass-through will not be applicable. So maybe we need to clarify it a bit here. Okay? You'll just have to re-clarify the word if pass-through accounting approach is impracticable in case of restricted one. If it is unrestricted, then this is no issue at all. Variable equity participatory venture like Nari Musharaka. Net investment in participatory venture approach and quasi-equity accounting approach. These are the only possible options. So effectively, this section, that paragraph 8 that we discussed, provides a summary of all the accounting approaches which are defined in different sections of this standard. This paragraph creates cross references to the relevant paragraphs. If you can see in the first column, all the relevant paragraphs are referred to in the left column. Now, just a second. Brother Much, what time we need to take a break? I think we have time.
If you would like to
No, I
have
don't
the middle,
take a break now. No, it's not prayer time. No, prayer time has not started in Bahrain. I think it will start at 11:28 or something. Am I right?
yeah.
So we'll take break at 11:30 maybe, or
At that time.
11:35. I just wanted to check whether we should continue before this or not. But
Okay,
before
25
I go
minutes.
to this one, I would like to conclude on the poll. Sister Hora, how many people have responded till now?
$47 out of 84.
Okay, Sister Noof, I think we should conclude now because I think other participants are not willing to answer on that one.
Yeah. Let's close the poll and get them the
Let's close the
results.
poll. Okay, so I'm just waiting. Okay, so the answers are keep as participatory venture. Majority is in the favor of renaming it as Sharia compliant participatory ventures to make it more clear. So, Brother Majd, I think if you recall, we initially had this term Sharia compliant participatory venture and short form was STPV
Yeah.
that we use as the standard. So, the public view is that it would be making it more clear.
Yes.
With regard to the name participatory ventures, people prefer that we put participatory ventures and in bracket Musharaka and Mudarba. And I think this is the view of the Sharia committee also.
Yeah.
So I think, again, decision will be, again, we have to discuss it working group first, what decision will be in the hand of the board. But I think that we can take it to the board now that the majority of the participants is in favor of mentioning it as Sharia compliant participative ventures to distinguish them with any other type of instrument that can be there. And similarly, people prefer that we mention as Musharaka and Mudarba in the name of the standard. I think this is the same approach that we did in investment account. We said that Islamic investment institutions, but in bracket we mentioned including investment funds to just make it clear that investment funds are the main user of that one. So I think this can be done. And I think there is a similar comment on Salam Istasna thing as well that we will have to discuss. Okay.
Okay.
Yeah, but I think my personal view based on what now we listen from the market is better to mention Musharaka and Mudarba in the name and also to mention even my view about Sharia compliant participative venture was already there. My personal view was that it should be called as SCPV, not only the PV. So considering it like these comments, thank you very much everybody who currently contributed to this poll. And I think that we will be at least we will be recommending this poll result should be incorporated by the board when we take it back to the board. Thank you again, everybody. So now we come to the next section of the standard. This section of the standard is about accounting and financial reporting in the books of account of the investor. Now, there are two main approaches for the investor. What are the two main approaches? Can I ask you? Anybody can respond? We discussed it above. I will highly appreciate if anybody can put this comment in the Q&A tab. If anybody can recall. For the investor, there were two main approaches. Okay, no response. For the investor, if it is restricted situation, that is a control is in the hand of the investor only and there is no shared control or no control of the working partner, in that situation, it will be passed through accounting approach. And all other situations, and where even in the first situation where pass-through accounting approach is not practicable, then we go to net investment in participative venture approach. Okay. So an investor shall apply either of the following. I already explained that part. Now in this section, we will learn how these two approaches are applied. Okay, let me put another question to the participants and maybe we can create a poll on that, Brother Majd, as well. The question is, in Wakala standard also we have a pass-through approach, but Wakala we believe that fundamentally is pass-through. Here, if you ask me, I believe pass-through approach may never be followed. Because there is only one situation of pass-through approach that is restricted Mudarba. In Musharaka, pass-through approach will not apply. Only in case of restricted Mudarba, pass-through will apply. We don't have too many pass-through approach. We don't have too many approaches of wakala, like of restricted mudarba, too many transactions of restricted mudarba. The question is, then what is the benefit of keeping this approach while there is a probability that 99.9% situation this will not be used? Even we had this question when we were putting this pass-through approach in the wakala standard. There was an argument in the wakala standard that we used. We said that it is possible that at times a wakala, and in this case a restricted mudarba, can be used by banks to avoid showing some assets on their balance sheet. So for example, it can be possible even I have a Sharia non-compliant investment. And that I pass on to Brother Maj and say, Brother Maj, keep this investment on your balance sheet. I will be showing only net investment in Mudarba with Brother Maj. Now, this standard asks for the underlying assets, the participatory venture accounting, and all these things. So the risk is reduced for Sharia non-compliant. But let's take another example. So Sharia non-compliant issue can be resolved partially by the standard even through because of underlying venture accounting, which was not very clear in the old standard. But if there is another situation. So for example, I have more concentration in one type of asset which I want to show less. Another example, I want to invest in real estate in the market where real estate investment for Islamic banks is prohibited by regulators. So in most of the markets, okay, in Bahrain and other GCC countries, normally it is not prohibited by the central bank to invest directly in real estate. But in some of the markets, the banks are not allowed to invest in real estate. So for example, let's take example of Pakistan or Bangladesh. So we say that there is, I'm the bank, I want to purchase a building and invest in real estate by purchasing that building. But I know that because of the regulations, I cannot put it on my balance sheet. What I do, I give that money to Brother Maj and say, okay, let's create a restricted mudarba or wakala, where you take 5% of the profit, I take 95% of the profit, and you may invest in real estate. So I will not be showing it as investment in real estate, I will be showing it as an investment in restricted mudarba with Brother Maj. That is the reason that we still insisted that even if it is the use is minimal, but pass-through approach should be the primary approach. So in that situation, the auditor can keep an eye and he can see if a restricted mudarba or wakala has been used just to circumvent the situation of investment in a prohibited asset or a asset that is not regulatory, not allowed by regulation, or where I do not want to show concentration in a specific type of asset, or I want to show some other, like, I want to mislead. The pass-through approach will require that I show it on my balance sheet. And that pass-through is primary approach for restricted mudarba, where the control is in the hand of the investor, except for it is impracticable. So we would like to listen to you, particularly with regard to this approach, that while the use of this approach might be limited and the standard may become simple if we say that investors should always use the net investment in participatory venture approach, but the risk factor with regard to misuse of restricted mudarba by misleading things would be a problem. With regard to the other part, like, that is The same thing can be done with restricted, unrestricted mudarba in form of musharaka. Yes, we cannot control that completely. Because, but the second part is that at least the second party is taking risk. In case of control only with the investor is taking risk. And he can try to mislead the thing. So while this approach should be the fundamental accounting approach that we understand, but we also understand that practicality considerations are there. But if we remove that from the requirements, what is the view of the participants here, particularly with regard to this one, that shall we keep it or shall we remove it completely, and for the investors, we keep only the net investment in participatory venture approach? It will simplify the standard. Only that spectrum may not be covered. And again, as I mentioned, that if the investor controls the underlying asset, the primary approach should be that we should report the asset in its book. Any comments on this one? I'm not sure whether we need to have a poll on that. Okay, I now have one comment in the Q&A tab. Brother Hamza Hilal, Assalamu alaikum and welcome, brother. It would be nice to have a certificate of attendance for this seminar. Okay, thank you very much, brother Hamza. On a lighter note, I can see the comments that should go to the chat window are coming to the Q&A tab, and those that should be coming to the Q&A tab are going to the chat window. This one for sure that can be provided. It's our policy that anybody who want to have a certificate of attendance, it is provided. So if you can kindly provide your email address to our sister Noof or another colleague, they will provide you a certificate of attendance, inshallah. It is not provided by default. It is provided for those who need it for the purpose of like CPD or want to show it. Okay. So thank you very much. Brother Much, I would be going to the chat window, but if you feel there is a good question coming on the chat window, you can just have a look at it and you can put that question so that it is at least not missed out. We did not receive any comment on this one. What do you suggest, Brother Much? Should we do a poll on this one?
Actually, we prepared one. I'm going through it now.
Okay.
Let's
do a poll. Let's do a poll. There is no harm in at least doing the poll. That would it be appropriate to keep the participatory venture pass-through accounting approach in the hand of the investor in case of investor only having the control? So if it is, if you feel that this is the more appropriate accounting, then we keep it. If you feel that simplifying the accounting would serve the purpose, we can consider and we will take it to the board. But I can tell you that the board has that consideration in mind, that a wakala or a restricted mudarba should not be used. One more thing, just to keep in mind, that we are asking the investee or the working partner to use it off balance sheet accounting. If you are off balance sheet accounting, then corresponding is because one of them has to keep in the balance sheet. So either the investee or the working party keep on the balance sheet, or otherwise investor keep on the balance sheet. So this is similar to what we do in case of banks. In case of banks, we say if you have restricted mudaraba or wakala where you do not control the asset, you put it on a balance sheet. Here we are also asking the working partner to put on balance sheet, which is aligned with what we have already put in the standards for maybe 30 years. Now what happens that if you do this accounting on the investee side, then somebody need to put on the balance sheet. Then it means that the investor should put on the balance sheet. That is also a justification that it aligns with the counterparty accounting, but still that question is relevant, that whether we use this approach which simplifies it or not. Now coming to the pass-through accounting approach. This pass-through accounting approach, as I mentioned, is in nutshell, in pass-through accounting approach, the underlying assets of the venture are kept on the balance sheet of the investor because investor controls them. Initial recognition. On initial recognition, using the pass-through accounting approach, the investor shall recognize the assets as well as liabilities, if any, underlying the participating venture in the books of account, applying the initial recognition principles as applicable in line with the relevant geography phases. Proportionate assets and liabilities shall be recognized applying the same principles in cases where the arrangement has more than one investor. Subsequent to initial recognition, the underlying assets and liabilities shall be measured according to the requirements of relevant UFI phases. Proportionate accounting shall apply where applicable. Explanation: these shall be recognized on a gross basis by the investor, that is, assets to be included in assets and liabilities, and if any, to be included in liabilities. An investor shall determine at each period an impairment in the value of investment and a pass-through accounting approach in line with the requirements of respective phases. The settlement risk as well as existence of owner's commitment, for example, a guarantee or a sale undertaking, shall also be considered for impairment purposes. Unless contrary to a specific requirement of this standard, the resulting revenues, expenses, gains, or losses arising from the participating venture shall be measured and accounted for respectively according to the nature of contract in line with the requirements of relevant UFI phases applicable to such transactions. Normal accounting policies of the investor shall apply in respect of all such matters. Revenues, expenses, gains, and losses shall be recognized on a gross basis, that is, same shall be included in the respective line items in the financial statements of the investor.
Brother Omar, in the chat box,
Yes.
Abdulaziz Al-Fal, he says working partners reflect mudarib and musharik, etc.
Yes, we discussed the definition already. Let me take you back to the definition and explanation. The working partner is a partner in a participative venture principally entitled to manage and or operate such participative venture and who receives equity contributions from the investor. Working partner at times may also commingle its own equity in the participative venture. Explanation: a working partner, depending on the nature of underlying contract, may generally include a mudarib or a musharaka's working partner. Not all musharik, but musharaka's working partner. But if the musharaka does not define a working partner, in that situation, all sharik are, as per Sharia, working partners. So they all become working partners.
Yeah, another question from Ramadani, Mr. Ramadani or Mr. Ramadani, I don't know. May a silent partner receive profit in ratio more than the ratio of his investment?
It is not allowed by Sharia standards. But what is a silent partner or a dormant partner need to be clearly defined. Means that if it is not defined that he does not have a right to interfere into matters, then every partner has a right to work as a working partner, so they all become working partner. But if it is defined in the contract that one of the partners will not have a right to interfere into the affairs of the musharaka, then he becomes dormant or silent partner. Further details are a Sharia issue, not accounting issue. The profit and loss distribution or the formula shall be according to Sharia standard, not accounting standard. Accounting standard defines how that formula need to be applied and how accounting and presentation need to be done. Now we have the second question about the participative ventures, that given that pass-through approach would generally be used in limited cases in participative ventures, particularly in restricted mudaba transaction where it is used in very rare cases, would it be better to keep pass-through accounting approach or simplify the standard and keep net investment in participative venture approach only? So I have already mentioned some of the pros and cons of the key offer and the justifications of keeping the pass-through approach. Brother Majd, whatever I have mentioned have been discussed in the working group and the board already, so it should be part of basis of conclusion as well. Either way, whether we keep it or we don't keep it, but this discussion is very important for the purpose of basis of conclusion. But let's listen to the participants. So now the poll is available with you, and you guys have to answer the poll according to your preference. So first approach is the way standard is written. It includes pass-through approach and net investment in participative venture approach. Pass-through approach, we believe that will be used in very, very limited cases. However, it may still be needed. Particularly, it also addresses some of the risks with regard to, some people just want to keep things out of the books and just want to show a net investment in participative venture. That is where we just want to control the situation. If the risk is shared by the counterparty, it's okay. But if the counterparty does not share the risk, then you cannot just avoid not putting them on your balance sheet. But Do you think that it justifies that accounting standard contains this whole approach to address that risk? And obviously, we believe that this is the right approach. That is part one of option one. Option two is simplify the accounting, keep everything under the net investment and participatory venture approach, which means that some of the paragraphs that we are discussing here will go away and accounting for the investor will become only one single option and more simplified. So, can I request all of you to answer this quickly? We have like nearly 90 participants, 93 participants. So request is that if we can have all of you answering it quickly, please. Okay, let me complete this section and then we will conclude in this poll and then we'll take a prayer break. Okay. So at this stage, we just go through this one. On the initial recognition, I think we discussed this one already, pass-through approach. Okay, so revenue and expenses, what we are saying that if I invested with Brother Maj through restricted Mudarba, Brother Maj invested my money into Sukuk and shares according to my instructions, not using his significant discretion and not taking a risk of loss. In that situation, control is mine. So the primary accounting is that those sukuk and those shares should appear on my balance sheet. Okay. Now it means that sukuk will be added to sukuk that I own. Shares will be added to shares that I own. If there are other assets, they will be added to other assets that I own. If there is a liability, for example, payable to broker for that, that will be appearing in my liabilities, will not be netted off here. The revenues and gains, according to my accounting policy, will apply. So, for example, the dividend revenue will go to dividend revenue that is going to my income statement, so it will go to that line item. Return on sukuk will be going to return on sukuk that appears in my investment. Gain or loss, unrealized gain or loss on sukuk and shares, depending on the classification that I have applied. For example, if it is at fair value through P&L or if it is at fair value through other comprehensive income, it will also go to the respective line item where I have. Now, what will happen if there is an undertaking or something that can turn onerous? In that situation, I need to consider that. If there is a settlement risk with Brother Maj, I need to consider that for impairment purposes. If there is a risk Brother Maj will run away, taking my assets, I need to consider that risk. This is what is required to be disclosed or disclosed and accounted for. So impairment of the assets will be there, including the settlement risk with Brother Maj or whoever the working partner is. This is the accounting under pass-through approach. Any questions for accounting under pass-through approach? Okay, no, let me conclude on one part. Now, Brother Maj as a working partner has a right to get some profit. So working partner share of profit payable, that I'm investor, I'm doing accounting in my books. So working partner share of profit payable according to the contractual arrangement, whatever the formula is, shall be recognized as an expense at the end of each financial reporting period based on the best estimates of account payable as at the respective period and based on contractual and constructive obligations. There is some calculation element in that. So any contingent or conditional variable share. So I said to Brother Maj that I give you 5% of the total profit. However, if you generate return on capital for me more than 10%, then I will give you, for example, additional 10% of profit over and above the 5%. This is where the conditional and contingent variable shares of profit are identified. So there can be different formulas for that. So we say that they should be recognized as an expense based on best estimate of the same, underlying the following principle. Variable share of profit related to past performance based on contractual arrangement shall be recognized as a liability when it becomes due. So at the end of the year, now I know that Brother Maj generated us 18% return. So it means that on 8% of the return, I need to give him additional 10% return, so that will be part of 10% of that additional 8% will be part of my liability today because it is based on past performance. Variable share of part profit related to past performance, which is contingently reversible on cumulative basis. So we say, Brother Maj, you have this right, but you need to keep this ratio going on. So if, for example, next period the result is less than 10%, then this amount will be reversed. In that situation, this reversible element, which is reversible in case of future loss or is contingently dependent on a decision of a third party, if we have a third party appointed who will be deciding, like a trustee or somebody who will be deciding this amount. So these are the situations when due, irrespective of probability of reversal. So probability of reversal is there, but I will record the liability being on a prudent basis. Reversal of a liability earlier recorded to recover a loss or against below par performance shall be recognized. Recognition of respective expense in the period when reversal occurred, and the variable share of profit related to a future fully dependent on future performance shall not be recognized. So Brother Maj says that, okay, initially the return is 10%, but by the end of the project, your annual return will be 30%. Okay, still I record according to the past performance today, that is 10%. Future performance adjustment will be done in future. This is the summary of accounting. Now I am trying to explain this part because this is a contingent calculation issue which applies in so many different situations, and how these are accounted for by the investor and by the working partner at times are different under different approaches. So I'll be explaining all these situations when we go through the section. So here we conclude the in the event of a negligence of working partner, that is also I'm missing. So if Brother Maj did not invest according to my instructions and invested according to his discretion in a venture, in a share where there is a loss. Now what happens? According to Sharia principles and rules, it can be established that the loss that is caused by him is to be compensated by him because it was a negligence by him or contractual compliance was not there. So his negligence need to be paid by him. So this will be recognized as my income and recorded as a receivable from Brother Maj when this negligence is established and the amount of compensation of loss is determined. Then we have presentation and disclosure requirements that all assets, liabilities, expenses, gains, and pass-through shall be presented on gross basis. They will be going to the respective line item, etc. And working partner share of profit according to Brother Maj, between paragraph 15 and 17 hyphen should be without spaces. It shall be included in relevant expenses and disclosed accordingly. In addition to normal presentation requirements, summary of contractual relationships should be provided. So ownership structure of the participatory venture should be provided. Nature of underlying assets and activity managed should be provided. And in contingent variable profit payable, which is not recognized because it's contingent, shall be recognized, shall be disclosed. Now, this is the first part of accounting. This is the one where we have asked you for the poll. So let's go for the poll now, and we listen to the participants how they have concluded on this. There are a couple of questions in the Q&A tab. So Brother Muhammad Usama Wakil has mentioned that pass-through approach is better to reflect true and fair view. Brother Muhammad Usama Wakil, thank you very much for your comment. He has another comment. May the investor have higher watermark clause on performance-based incentives? Yeah, these are the things that are the parts that we need to manage at our end through proper planning, risk management, governance. So there are a lot of activities that you need to plan, but from the accounting perspective, we are trying to define what needs to be done. Now let's go to the poll. The results of the poll are that majority of the participants, that is nearly 2/3, 64%. How many have answered, sister? 39 have answered. So majority have not answered actually. Majority have kept quiet. There is always a silent majority. You know, always in the democracies, there is always a silent majority. Anyway, so the majority, that is two-third majority, they say that pass-through accounting approach shall be kept. There is one-third roughly who say that we should be removing pass-through accounting approach and we should be keeping only one accounting approach. So I think we completed this section here and it is 11:37 Bahrain time. I think this is a long public hearing today and there is a prayer time break that was planned already. So I think we should take a break now before moving to the next section of, again, will be still continuing the investor accounting, but we'll coming to the more common type of investment accounting, that is net investment in participatory venture approach. This is, so Brother Wes, I think we can take roughly 23 minutes of break and we can start 12 Bahrain time again.
Sure. But may we request all our participants to keep connected, silent and connected.
Thank you very much, everybody, and looking forward to see you all after this short break of prayers. And if anybody wants to stretch their legs, etc., have a coffee or something, please.
Okay, sure.
Assalamu alaikum.
Alaikum assalam wa rahmatullah.
I think we should start now again.
Yes. Though I think part of the participants, a number of participants dropped.
Which
Maybe they
it's a
will.
lot of public hearing, and taking a break means that some
Yeah.
of them obviously will be joining a bit late. Some may be dropped out.
Maybe
But
they can.
cannot
Some of them
continue
can
that long
rejoin.
without a break actually.
Yeah.
So it's okay. I think we can continue, and then let's hope for the best. A couple of comments in the Q&A tab. Okay, Brother Muhammad Zafar Ahmed, Walaikum Assalam, and Brother Hamza has put his contact address for the certificate. I think we should continue. So I think with the benefit of time, the time that we agreed is over. A couple of minutes above that. So let's start. So before the break, what we discussed was that is how we put it. That is the first type of accounting for investor. The first type of accounting for the investor was under the pass-through approach. As we have gone through the poll, the majority agrees that should continue in the standard. At least the majority continues, and we received a couple of comments also that this is actually the right approach to provide true and fair view. So we should keep it, even if we understand that its use is minimal. Now, coming to the second type of accounting, and which will be more common type of accounting for the investor. And actually, it will be accounting for the working partner also in some of the situations, as we will go through the accounting for the working partner. So it will be the most dominant form of accounting for participative ventures. Accounting by the investor under net investment in participative venture accounting approach. Initial recognition. While applying the net investment in participative venture accounting approach, an investor shall initially recognize the investment made as an investment in a participative venture at cost at the time when it is made available to the prospective working partner for investment. In case of investment in kind, and this answers a question that was raised earlier by a participant, in case of investment in kind, the initial recognition shall be based on the fair value of the in-kind investment at the end date of the investment. Now, this is important. So let's take again example of me and Brother Maj. So, for example, I have appointed Brother Maj to manage Sukuk on my behalf as a working partner, and we create a venture. In that venture, I am the investor, but for example, we have shared control, or Brother Maj has the control. Because if I alone had the control, then it is the other approach that we already discussed, that is the pass-through approach. Now, this approach that we are talking about is where Brother Maj has a shared control with me, or only Brother Maj as working partner has the control. In that situation, I will record my initial investment at cost when I make it available to Brother Maj. But if I already had some sukuk or some other assets that I need to pass on, I need to pass them on to Brother Maj at a fair value. Because from the Sharia perspective, you need to calculate the real profit and loss of the venture. So from that perspective, it is important that the initial investment in kind is also recognized at fair value. Now, this is obviously at times, fair value or the agreed value is at times after some adjustments to fair value, because again, till the time you don't sell something in the market, you don't find the actual fair value. There are values that are available in the active market, those are to be applied. So it is also possible that in that situation, I have a gain or loss, because that asset may be appearing in my balance sheet at cost, or a fair value which was earlier recorded different from the fair value that is there. So there can be a gain or loss that is appearing in my books of account that also need to be accounted for, that we are going to discuss later. In the case the investor has made initial investment available to the prospective working partner, but the contract is yet to be initiated. So I have passed him on the money, but the effective date of the contract is not yet there. In that situation, such amount shall be initially recognized as an advance against investment. My apologies. Advance against investment in the participatory venture till the time such contract is initiated. Subsequent measurement. The investment in participatory venture shall be measured at the end of a financial reporting period at carrying amount adjusted for additional capital contribution, capital withdrawals, and payment of distributable profits, and shall be adjusted to include the net share of profit or loss of the participatory ventures as attributable to the investor under the contractual arrangement as determined under the relevant TOFI phases at that date. Now, this fundamentally changes things. Those countries, again, we don't have any disrespect for anybody like as a regulator or as an institution opting for a accounting policy. But just like to mention that the countries where IFRS is being followed, and again, we have all the due respect for IFRS, but the point is the way IFRS is interpreted and applied at times need to be reconsideration. So the problem is, I am aware of the situations, and we have noted these situations in different parts of the world where under IFRS, these are considered as financing. When you consider them as financing, you started recognizing the expected profit on an accrual basis. Sorry to say that is money on money. Because the real profit and loss distribution is the basis for determination of how much is your rightful receivable from the venture or the working partner. I'm the investor. I agreed with Brother Maj that I invest with him with 20% his share and 80% my share, and he said that my expected rate of return would be 8%. Now, what is happening in some parts of the world where AOP standards are not being followed, and we know that this is creating more and more accounting complications. Now, what happens that the entity that is the investor, that is the Islamic bank. Now, let's take example of running musharaka. Let's take example of diminishing musharaka type transactions that we see in different parts of the world. At times, Islamic banks are accruing profit based on expected profit rate. Now, this is where the fundamental accounting treatment, which should be like venture accounting, again, under IFRS, so the venture accounting is what we are seeing here right now. The venture accounting under IFRS is primarily equity basis accounting, equity method of accounting, what we are asking here now, which means that you need to determine the real profit and loss of the venture and then incorporate it in your books. You cannot start accrual at 8%, which is the expected profit. In the beginning, if you recall, I mentioned about mimicking of conventional, but the unfortunate part is that at times you try to do Sharia compliant product like musharaka and mudaraba, and we try to mimic conventional on the accounting side. Anyway, the treatment that we are mentioning here is principally the same as was there in Phase 3 and Phase 4, which are still in place. So our Phase 3 and Phase 4 talk about distributable profit. Distributable profit is the basis of subsequent measurement, and here we are just clarifying the wording, making it more aligned with the IFRS and our new AOP standard. But in a nutshell, what we are saying, the investment in a participating venture shall be measured at the end of a financial reporting period at carrying amount adjusted for additional capital contribution, capital withdrawals, and payment of distributable profits, and which shall be adjusted to include the net share of profit or loss of the participating venture as attributable to the investor under the contractual arrangements as determined under the relevant AOP phases as at that date. Net share of profits or losses during comprising of net results of revenues, expenses, gains or losses arising from investment in the participating venture shall be determined after allocation of working partner share of profit, including variable profits. Any share of loss is reimbursable by the working partner as established in line with Sharia principles and rules due to working partner's negligence and misconduct shall be recognized as a reduction in losses or a profit where applicable when determined as such. The investor shall determine at each each period an impairment in the value of investment in a participatory venture in line with the requirements of respective UFI phases. The settlement risk as well as the existence of onerous commitment, for example, guarantee or a sale undertaking, shall also be considered for impairment purposes. Brother Ahmed, I think just keep for the record purpose, I think we should mention or a sale or purchase undertaking. Wherever we have used the term sale undertaking, we should say sale or purchase undertaking.
Okay.
Yeah, because at times it's a sale undertaking by one party, or at times it's a purchase undertaking for the counterparty. Share of profits and losses arising from investment in participatory ventures shall be disclosed separately from other revenues of the investor on a net basis. In addition, the investor shall disclose the following as the minimum disclosure requirements, like the principal terms of the agreement, nature of underlying assets, etc., the contingent profits payable to the working partner not recognized, etc. In respect of any investment in participatory venture which is considered material to the financial statement for the investor, financial statements of the investor shall preferably provide memorandum information in respect of assets, liabilities, revenues, expenses, gains and losses, as well as profit and losses attributable to the working partner. There are a couple of comments, one comment again coming that there is an echo that is felt. Again, let me ask the question if our partners are feeling echo. Let me try to use the other microphone. Some people said that the sound was still okay, but I'm just trying to change the speaker. No, sorry, microphone.
Okay, let me ask Brother Majd and others, is my voice better?
Now better, yes, now better.
Okay, I hope it works for everybody. Thank you very much, Brother Mustafa Al-Kaiser, for reminding me for this thing. Thank you, and my apologies for the inconvenience. I hope it would work better. Okay, so now we complete the investor accounting in the based on situation. One, investor controls. Second, investor controls shared with working partner, or third situation, or second situation is where working partner control. Third situation where investor and working partner have shared control. In situation number one, that is where investment controls underlying assets, the primary approach is pass-through approach. But if pass-through approach is not possible, practicable for any reason, then net investment and participatory venture approach. With regard to the other two situations where the working partner controls or the working partner and the investor have shared control, in those situations, the only accounting approach that applies is net investment in participatory venture approach. As I mentioned, in the primary approach in which investor controls is restricted mudarba. Other than restricted mudarba, almost all forms of musharaka and unrestricted mudarba will all fall in either of the working partner control or shared control situations. So as we mentioned, in majority of the situations, a vast majority of the situations, only net investment in participatory venture approach, where the underlying assets result, underlying business result is the basis for subsequent measurement is used. So this is a recap of the investor accounting. Now we are moving to the next section, which discusses the working partner accounting. Okay. Again, working partner, what are the situations? The working partner shall apply any of the following approaches for accounting and financial reporting of its interest in a participatory venture. A, in case working participatory venture is controlled by the investor only. It can be multiple investors. So we use the term investor in bracket S, which means that it is possible that there are 10 investors investing in one, or there may be 1,000 investors in form of sukuk holders investing in one venture. So if it is controlled only by the investors, off balance sheet accounting approach will apply. That's it. You cannot put something on your balance sheet which you don't control, even if at least you don't share control. So if it is controlled by investors only, off balance sheet approach. That is the first approach that we are going to read in this section. In case of participatory venture, is controlled by the working partner only. We were taking the example of me and Brother Majd. So here, Brother Majd has the discretion with regard to the decision making, and Brother Majd is also sharing the risk of loss, and hence the participatory venture is controlled by Brother Majd alone. In that situation, quasi-equity accounting approach will be followed. This accounting approach is similar to what Islamic banks follow in case of unrestricted investment accounts, or as we call profit and loss sharing deposits in some parts of the world. In case the participatory venture is under shared control, that is, working partner and investor have shared control, the net investment in participatory venture accounting approach will be followed by the investee also, which means the working partner will also become an investor and he will follow investor type approach. This we have discussed already. Accounting by the working partner under the off-balance sheet accounting approach. Under the off-balance sheet accounting approach, a working partner shall not recognize the assets or liabilities underlying the participatory venture controlled by the investor in its books of account. If the working partner previously owned such assets and liabilities through equity or quasi-equity, the working partner shall de-recognize the asset and liabilities from its books of account, and any gain or loss on such disposal shall be recognized immediately, being the difference between the carrying value of such investment and assets and liabilities and the value agreed upon contractually. Investors' share of profit. Net share of profit duly comprising of net results of revenue, expenses, gains, and losses arising from investment in the participatory venture after allocation of the investor's share of profit and losses where applicable shall be recognized periodically. Any share of losses reimbursable to the investor as established in line with Sharia principles and rules due to working partners' negligence and misconduct shall be recognized as an expense when determined as such. Contingent or conditional share of profit receivable by the working partner as per contractual terms shall be recognized when there remains no material certainty. Now, the situation for the investor versus investee. Situation about the right and obligation. For even under IFRS, for a contingent liability to become a liability, you need more probable than not, which means that more than 50% probability of something becoming an expense or a liability is to be recorded as expense and liability. On the liability, 50% probability, that is more probable than not. On the asset side, when you need to recognize the revenue and asset, if it is contingent, you can recognize it if it is virtually certain or where there remains no material uncertainty with regard to that. That is nearly 90% of the certainty level. So here on the asset side, you have to apply no material uncertainty condition. On the expense side, you need to apply the more probable or not than not condition. No material certainty or virtually certain means 90% probability that it will be coming in. More probable than not means that this is 50% plus probability that you will have an expense. Accounting goes by prudence, which means that you have to be prudent. So if it is more probable than not, 50% prudence, you record liability or expense. On the asset and income side, you have to be virtually certain about something. Till the time it's not virtually certain, till the time there is no material uncertainty, till that time you cannot record it. So the investor share of profit, the contingent and conditional share of profit part applies in this way. So this is the difference between the accounting on both ends that we have talked about. So here we are talking about the same thing depending on So we are saying what was to be recorded there as an expense being on a prudent side is not recorded as a income here as a prudent side. So I'm not going to go word by word in this part. I'm just explaining you the summary. And then obviously we have these presentation and disclosure requirements where the working partner should disclose about the summary of assets, liabilities, remaining movement. In case of off-balance sheet, a statement of asset under management or in the notes. So if you are yourself a financial institution and you have a statement of off-balance sheet assets under management, then you take it to a statement of off-balance sheet assets under management. If you are not following the off-balance sheet asset under management statement, then you disclose it in the notes to the accounts. But the disclosure requirements will be similar to what are there in the off-balance sheet asset under management. The disclosure standard, as per the standard is now already finalized, is no more in the ED stage. Total administrative and operational expenses charged to participating venture along with description are required. Amounts of profit and losses attributable to investor and the incentive tiered profits, all these are to be disclosed. Basis for determining variable share of profit need to be disclosed. Cumulative amount of contingent share of profit receivable but not recognized to be disclosed. Transfer of assets between pool means that there is a standard AOF financial accounting standard, and now the revised one was also issued last year before this one, 2023. So the transfer of assets, internal transfer of assets are to be disclosed as well. So if you transfer from your own assets to the shared assets or the assets under the off-balance sheet, you need to do the appropriate accounting and disclosures. Now, this is the first approach that we discussed. Now, that was off-balance sheet approach. Now, coming to the quasi-equity accounting approach, which is, we believe, will be the most common approach by the working partner. This is the approach similar to the most of the banks in case of unrestricted investment accounts and PLS deposits. In this one, a working partner shall recognize the amount of quasi-equity of a participating venture in its books of account equal to the amount of cash received or the fair value of the underlying assets received. At the time of initial recognition of quasi-equity, in line with the requirement of paragraph 38, the underlying assets and liabilities shall be recognized on the books of account of the working partner. So when you do the quasi-equity accounting, you record, because you control, or in some situation you may have shared control, you record all of them in your balance sheet. So all assets, liabilities come to your balance sheet. This is similar to what banks do. So banks record all the assets underlying the unrestricted investment accounts and PLS deposits. So similar manner, you record all the assets and liabilities in your books of account. So these are to be carried at the current carrying value of such underlying assets already owned by the working partner as appearing in the books of account of the working partner in case investment is received in cash and the value assigned to underlying asset is equal to carrying value, at the contractually agreed value of such underlying assets in case the investment is received in cash and the value assigned is different from the carrying value, or the contractually agreed value of underlying assets as of the date of investment in the event of investment in kind. Do we have any questions? I can't see any questions, so let's move ahead. I hope people are not sleeping. In case of application of paragraph 39B, any difference between the contractually agreed value and carrying value? Okay, now what happens that if I have my own assets which are used as a underlying asset of this investment pool of this participatory venture, and if the value assigned is different, then there is a gain or loss. So any gain or loss, if it is not impairment loss, if loss is not impairment loss, that will be amortized over the period of participatory venture. Why we are asking for amortization? Because we don't want a day one gain or loss on this one, because whatever difference of value is there, that is done in the anticipation of recognition of that gain or loss over the period. So we require that the working partner should be recognizing it over a period of time. This accounting treatment is similar to accounting treatment that is done in case of leases, sale and lease back situation. So more or less, it is the same analogy that has been applied here. So Now, this is the normal situation, except for unless the participatory venture does not have a fixed period of maturity, or if it is not committed or reasonably expected that the working partner will acquire full ownership of the underlying asset of the participatory venture, either through gradual transfer of ownership or at the end of the term of participatory venture. Brother Maj, if you need to check if there is extra space after venture. Okay, I think there is extra space here. In which case such gain or loss shall be immediately recognized by the working partner. So I paid cash of, for example, 100,000 BD to Brother Majd. Brother Majd allocated assets out of his own assets to the equal amount of 100,000, but the book value of those were 80,000 in his books. Which means that Brother Majd has a gain of 20,000. Now, if the venture has a maturity, it means that Brother Majd today recognizes a gain, and in future he will recognize a loss. So what we are saying is that Brother Majd does not justify recognizing that gain immediately if the venture has a period, has a maturity, and maturity means that it is expected that Brother Majd will acquire back the assets from the venture again, from me again, which means technically it is a gain today and a loss over a period of time. So accounting requirements similar to the lease accounting, the same analogy we apply, that since it is expected that Brother Majd will acquire the assets again and he keeps the control of the asset. We are talking the situation where he keeps the control. So since he is keeping the control, he is not losing the control, either keeping full control or share control. So it is not justified that he keep the asset in his control and he recognizes a gain or loss. So in that situation, that gain or loss will be amortized over a period of time over which the participatory venture will mature. This way, day one gain or loss will not apply except for impairment loss. If it is identified that the loss element is actually an impairment loss and there is an impairment as of that date, then Brother might need to recognize that as an impairment loss on that date. Second situation, if the venture does not have a maturity, or and if it is not expected that Brother Majd will acquire back the asset again from me or from the venture, in that situation also he need to recognize the gain or loss immediately. This is situation A. Coming to situation B, any loss being an impairment loss shall be immediately recognized by the working partner, because it means that the value that we are agreeing is already a lost value from Brother Majd at the time the venture starts, so he should recognize that loss immediately. Subsequent measurement. Subsequent to initial recognition, a working partner shall follow its normal accounting policies established in accordance with the relevant AOP phases with regard to accounting for the underlying assets and liabilities and recognition of relevant revenues, expenses, gains and losses, including impairment losses or underlying assets, if any, relating to subsequent respective participatory venture. The investor's share in profit or loss payable shall be recognized at the end of each financial reporting period as an expense according to the contractual arrangements. Any share of loss are reimbursable to the investor as established in line with Sharia principles and rules due to working partner negligence shall be recognized as an expense when determined as such. A provision shall be maintained for any contingent or conditional share of profit attributable to the working partner as per contractual terms in respect of any variable share of profit related to past performance which is contingently reversible or a cumulative basis or is contingently dependent on a decision of a third party. Out of such provision, an amount may be taken to income if and only to the extent that there remains no material uncertainty based on justifiable future projections and established customary practices that such amount is no longer payable. So any contingent or conditional part should not be taken to income unless it is not certain. Then there are presentation and disclosure requirements about the underlying assets, liabilities, etc., administrative and operational expenses that have been charged, the amounts of profit and losses attributable to the investor and the working partner, and the incentives, etc., and the basis applied for determining variable share of profits, cumulative amount and movement of provision against contingent share of profit and considerations, and disclosure of transfer of assets. Additional considerations, we have suggested that in addition to the specific requirement of this standard, the requirements of respective AOFI FAS applicable to quasi-equity, that is the investment quasi-equity standard, earlier FAS 27 and now quasi-equity standard, shall be applied by the working partner insofar as practicable. Brother Maj, here also we need to update the standard because new standard has been issued in 2023. Third type of accounting, where you have shared control, what will happen? You will go, even the working partner will go to the net investment in participatory venture approach. Since that approach is already defined in the other section, we are not reproducing the same, otherwise it will be a complete reproduction. So when you have that shared control situation, that makes you yourself as an investor. So you do the investor accounting similar to that. Any questions on this section before we move to the next section? Okay. Now, there are some specific considerations. So first consideration is about perpetual participatory ventures. We discussed it briefly when we were discussing the summary. Certain participatory ventures, though in rare circumstances, may be perpetual in nature. That is, these are not subject to liquidation at a fixed maturity date, or these do not have a put option of redemption in the hand of the investor. So these are technically equity. So there is a rebuttable presumption that such participatory venture may qualify for accounting as equity under the requirements of relevant AOFI phases and presented as a separate class within equity. In such case, the working partner should follow the accounting requirements applicable to underlying assets under the quasi-equity accounting approach as prescribed in paragraph this to this, insofar as practicable, while following other requirements of the relevant AOFI phases. And the investor shall follow net investment in participatory venture accounting approach as prescribed in paragraph this to this. Transfer of control from investors to working partner. This is the situation where at the end of the term or during the term, you transfer the control, investor pass it on to the working partner. So there are different forms of transfer of control. Transfer of ownership and corresponding control from investor to working partner in case of most participative venture takes place through transfer of control entailing risk and reward incident to ownership of such underlying asset under a separate arrangement taking form of either of the following. Sale undertaking by the investor or purchase undertaking by the working partner executable after the end of the participative venture term or at the times when a specific event triggers early liquidation of participative venture, or gradual sale of proportionate ownership, generally in form of ownership units through a promised mechanism over the term of participatory venture, or partial redemption of owner's equity, investor's equity through partial sale of proportionate ownership, generally in form of ownership units based on mutual agreement before intended maturity of participatory ventures. Transfer of control, this is continuing. Timing of transfer of control. The transfer of underlying assets ownership or proportional ownership shall be accounted for by both parties at the time of transfer of control to the working partner. The time of transfer shall be coincide with the timing of consummation of the relevant contract through documentation of offer and acceptance of transfer of ownership, or payment against purchase of US units as a continuing arrangement and acceptance of such payment if already documented through a purchase undertaking in line with Sharia principles and rules. I can't find any questions, so either all of you are sleeping or, as I say, I'm too good. I believe, Brother Maj, I'm too good. But I will highly appreciate if we can have some questions here, please. Okay. Now, the more important part is that we are not getting enough comments, so either everybody agrees with whatever has been written, that this principally reflects the true and fair accounting, or otherwise maybe we are still trying to understand the complications. I can understand that I can understand it's a detailed standard, but I can assure you that it's a very simple standard. It's detailed, but it's still simple. There are a couple of complex things like contingent share of profit, etc. Removing those, it's very simple. Under all forms of intended or mutually agreed transfer of control or proportion thereof from the investor to working partner, the transaction of transfer of control of underlying assets or proportion thereof shall be recorded separately from the transaction of investment in participatory venture This is because Sharia requires that you cannot combine these things together. So that is why we have required this thing. And even if there is a gain or loss on that one, we have asked it to be different. The investor, irrespective of the accounting approach followed, shall derecognize the underlying assets or proportion thereof from the books of account while recognizing a gain or loss on such transfer being a difference between the carrying value and fair value of the consideration received. Brother Majd, I think we need to just be consistent with regard to or proportion thereof. In paragraph 51, we have written it as bracket. In paragraph 52, we have put it in commas. You need to see what was the final agreed approach, and we need to be consistent. We can discuss it later, but I think even proportion thereof in paragraph 50 is appearing in brackets. So if we are using in brackets, then I would say that we should use in brackets in paragraph 52 and everywhere else we have used in the standard. 53, the working partner at the time of partial acquisition of control shall apply the respective accounting treatment from the following corresponding to the accounting approach being followed. In case of quasi-equity accounting approach, shall record a reduction from the amount of quasi-equity reflected in financial statements while recognizing a gain or loss on such transfer being difference between the carrying value of such proportion of quasi-equity and fair value of consideration paid or payable. Which means asset value will not change. Assets are already on my books. They will not change. But quasi-equity reduces. Now, I receive money against quasi-equity. So if that is more than quasi-equity, I recognize again. If it is less than quasi-equity, so I just adjust on the quasi-equity side. The payment side, it is paid, not received. So payment side, payment of quasi-equity side, the gain or loss will be adjusted on that side, but the asset value does not change because asset is already in my books, is already in my control. B, in case of applying the net investment in participative venture approach, shall increase the amount reflected at net investment in the respective participative venture at cost. So if I was earlier owning 60% of the venture, now I own 65% of the venture. So I will increase my asset here. Okay, we can see a couple of questions in the, okay, there is good question by Brother Amadou Diab Sok. How about if the asset value decreases in the market? Thank you very much. This is a good question. So we are talking about different approaches of accounting. So for example, if it is quasi-equity approach, then obviously I will apply the impairment approach on the asset. If it is impaired, the impairment loss will be part of the profit and loss determination of the venture. So it will be shared between me and the investor. If asset value decreases, but at the time of transfer of control, I still own the asset. So I will record the adjustment in quasi-equity and asset will still be subject to impairment. And according to my ratio of ownership, I'll take the hit and the investor at their share of ownership, they will take the hit. Thank you very much. I hope this is clear, but if you still want further clarification, please let me know. There is a rebuttable presumption that a working partner applying the off-balance sheet accounting approach may not experience partial transfers of control from the investor except for extraordinary circumstances. In such, okay, now if the working partner is getting control of asset partially, even in case of an off-balance sheet, it means we need to reassess whether off-balance sheet approach was correct or not. Because it means that there is some sharing of control. In case of sharing of control, either I apply the quasi-equity accounting approach if I control, or in case we share the approach, we have both apply the net investment in participative venture approach. So the point is that if in case of off-balance sheet approach and pass-through approach, there is a partial transfer of control that requires a reassessment of the accounting model. When you acquire the complete control, you should apply the respective accounting treatment from the following corresponding to the accounting approach. In case of off-balance sheet accounting approach, you shall recognize the underlying assets of the venture in books of account while recognizing a gain or loss on such transaction being the difference between the fair value of underlying assets and liabilities and a net and the consideration paid or payable. In case of quasi-equity accounting approach, de-recognize the amount of quasi-equity and recognizing gain or loss, if any, on the recognition between that being the difference between carrying value of quasi equity and consideration paid or payable. In case of net investment in participative venture approach, shall de-recognize net investment in participative venture and recognize all underlying asset and liabilities in its books while recognizing gain or loss between the two differences in the P&L. Onerous commitment situation for redemption and gradual transfer of ownership. So, for example, in our situation where me and Brother Majd were having a transaction of Mudarba, where Brother Majd has a undertaking that he will acquire the assets at the cost value that is 100,000, but the asset value has gone down to 80,000. Then if that purchase undertaking, again, there is Sharia issue with regard to this one. I'm not going for Sharia issue right now. There can be different situations which are Sharia issue. Sharia issue is not the accounting issue. We are simply saying if there is an onerous situation on either party, that onerous situation which will result in a difference of loss that is identified today but will happen in future, that loss because of prudence approach need to be recognized today. This approach is similar to what we have in our FAS 30 and other accounting standards. In case of gradual transfer of ownership, there is a rebuttable presumption that a participatory venture with gradual transfer of ownership, for example, in case of diminishing musharaka with shirkutul laf, may not be eligible for any other accounting approach except for, in case of investor, the net investment approach, and in case of working partner, the quasi equity approach. In case of a variable equity participatory venture like running musharaka, only the following accounting approach shall be applied. In case of investor, the net investment in participatory venture approach. In case of working partner, the quasi equity approach. Now, you will ask, what is the difference between paragraph 58 and 59? 58 applies to gradual transfer, that is diminishing musharaka. 59 applies to running musharaka. In 59, we are saying that these are the only possible approaches. While in case of 58, we are saying that there is a rebuttable presumption, which means that in rare circumstances, the management may conclude that given the situation of the case, these approaches are not suitable. Rather, another approach is more suitable, again, within the approaches defined in this standard. The drawdowns and redemption shall be generally at cost in case of running musharaka. Now, variable equity participative venture attribution of profit and loss shall be made according to the weighted average balances and the agreed ratios, etc. And some of the specific requirements of quasi-equity standard shall be applicable. We have specifically mentioned that risk reserves, if they are maintained, shall be accounted for in line with the relevant OFI FAS, that is FAS 35. Now, we complete this section of accounting by the investor and investee in special consideration. So this section was on special considerations like onerous, like running musharaka, like diminishing musharaka, like the gradual transfer of ownership, like transfer of ownership or control, like settlement and liquidation. So these are issues applicable to both investor and investee in special circumstances. These are covered in this section. Now coming to the last section, this last section is about accounting and financial reporting by the participative venture. So we are saying, which is not, it was not there in our earlier standard, but here we are asking that, okay, let me read it out because this objective of accounting and financial reporting clarifies what I want to say. So let me read out. The objective of financial reporting for the participative venture is to provide timely and faithful information about the financial position and results of operation of the participative venture to both the working partner and the investor in order to enable them to incorporate such financial information in their respective financial statements on a periodic basis in line with the requirements of this standard and as contractually agreed or required by the regulations. In my earlier career as an auditor, I used to audit oil and gas company as well, where the joint ventures used to submit a periodic monthly statement of assets, liabilities, income, and expenditure. And each of the joint venture partner used to incorporate that in their results. This is The joint venture accounting approach that we have followed in this participatory ventures, we did not use the term joint venture to distinguish the Sharia compliant participatory ventures separately from common joint ventures, but some of the accounting approaches that we have kept and the principal accounting approaches that we have kept are similar to joint ventures. So the question is, if the participatory venture or the joint venture do not submit this information to the investor and in some cases to the working partner also, what happens? They cannot recognize anything. Now the issue of accrual like conventional interest-bearing transactions comes up. In conventional, you make accruals. In Islamic, you cannot make accrual of income that will be coming up in future. Till the time, current standard use the term distribution of profit. Till the time you do not calculate and distribute and allocate the profits, distribution doesn't necessarily mean payment. Means that you need to do the calculation of profit and attribute to the respective parties. That is the fundamental for the investors and also to the working partner to recognize what is to be going to their financial statements. And that is why we have included this very important section here. Summarized financial information of the participating venture as a virtual entity shall be prepared in line with the requirements of the standard on a periodic basis, commensurate with the financial reporting requirements of the working partner as well as the investor. The summarized financial information of the participatory venture includes a summarized report of financial position like balance sheet, a summarized report of income and expense, and explanatory material to the financial information. We are not asking a detailed set of financial statements. We are asking a very summarized set of financial information, including a balance sheet, income statement, and notes where information is necessary. Selection and adoption of accounting policies, in a nutshell, what we say is that it should be generally what working partner is doing, but in some situations, accounting policies selected and adopted can need to be aligned with the accounting policies with the contractual agreement. So primarily, there will be the policies that are followed by the working partner, but in some situation, the adjustment is needed for the purpose of contractual, including some judgments and estimates. So accounting policies applied for purpose of participative venture may be different from those applied by working partner if either of the following conditions is met. Such accounting policies better reflect the accounting and financial information in line with contractual requirements between the parties and business model of the participative venture. And secondly, the accounting policies generally applied by working partners are not in line with the OFI. So what happens that, for example, if the accounting policies of generally of the working partner are not AUFI compliant or Sharia compliant, in that situation, it is better that the accounting policies of the participatory venture are Sharia compliant and AUFI standards compliant. With regard to determination of accounting policies and judgments and estimates, some of the considerations related to participative venture shall be more specific, like the business model or term to maturity. So, for example, if the term to maturity is 5 years, you might need to depreciate assets over a period of 5 years with residual value to be transferred. So, these are the things that are more specific to the participative venture. So, those accounting policies and significant judgment and estimates, including depreciation, amortization, need to be adjusted. General accounting consideration should be where as far as possible should be performed in line with the accounting policies selected and consistently applied, and judgments and estimate applied in requirements of the release standard and element of fee phases. Gains and losses applicable to investor working partner prior to at the time of commencement of working participative venture are not part of the participative venture. They are to be recognized separately. Any redemption of quasi-equity, drawdown, or additional quasi-equity that result in transfer of asset to participative venture to other party shall be accounted for as carrying value. And then we have general basic presentation and disclosure requirement, which are about the nature of participative venture, underlying assets, main activities, contractual requirements applicable to investment, any changes to that, governance structure of the participative venture, information about ring fencing, if there is ring fencing of the participative venture or if it is not properly segregated, fair valuation of the participative venture and significant underlying asset where possible, and the information about tangibility of underlying assets, because in case of passing on share from one to another or selling the asset to other, it is important that the underlying assets are tangible. So tangibility requirement, liquidation of participatory venture, the transaction execution and financial effects, and the risk reserves if there are any. In addition, the disclosure about the charity, etc. Brother Majd, with I, there is a full stop, and there with H, there is an and which need to be removed. Okay, because this is continue. Sorry, so my apologies. The other one. Sorry. No, sorry. My apologies. This was my mistake. The page switched over. So disclosure about charity and zakah related to participative venture should also be made in line with the requirement of relevant standard. The effective date that we have suggested originally is 1 January 2026. According to the policy of the board, normally we give at least 1 year time. So exposure draft was issued in 2023. So we felt that 1 January 2026 is enough. But I think now we are already in 2025, and by this standard is intended to be finalized in next 3 to 6 months. So probably the effective date would be 1 January 2027. Brother Majd, please make a note of it for the board and the working group. But let's ask the participants also that if they feel that 2027 would be okay, or if they want more time for appropriate preparation for this one, at least comments that whatever comments we received are most welcome. So with regard to transitional provision, there is one main transitional provision that the option is available that if you are already having some participative ventures which are running in past, you can opt for this to be applied on prospective basis, means that new transactions will be subject to this one and old transactions may continue the old approach. But in that situation, if it is material, it should disclose the impact of the same. So here we conclude, this standard will supersede standard number 3 and 4, phase 3 and 4, for which are on applicable and mudarba and musharka. So before I hand it over back to Brother Majd for conclusion, I think we are a bit fast today. We have concluded it a bit early, and I think the main reason is there were not enough questions. We have one comment from Brother Jafri Kiswani. Thanks very much for the presentation. It's our pleasure and it's our honor that all of you are here. The standard setting cannot be done just in a boardroom. It is very important that we bring it to the industry participants at large. Highly appreciated attendance from all of you. Okay, this is our brother from Tanzania. Most welcome. Brother Majd, I think today attendance was a bit less, so we need to be a bit more focused on the attendance part. But again, I think it was second public hearing or first public hearing?
This is the second.
Second, yeah, because first we did some time back. Yeah. There will be one more public hearing in English, and there will be one public hearing in Arabic, inshallah. So with that, we have already got it reviewed by the Sharia committee. So we intend to finalize it by the end of first quarter or second quarter of the current year. We received another comment here. I think, no, it's a chat window. There are Brother Yusuf Sayyed. Thank you very much for joining in. Highly appreciate all the comments that you always provide as working group or as participant in the public hearings. With that, I would like to thank you all again and hand it over to Brother Majd for conclusion.
Thank you, Brother Ahmad. Thank you very much. Ladies and gentlemen, distinguished participants, dear colleagues, having reached the end of today's public hearing session on the newly issued exposure draft of Financial Accounting Standard on Participatory Ventures, I would like to thank firstly Mr. Omar Mustafa Ansari, AYOFI's Secretary General, for the insightful and thorough presentation of the exposure draft and the answers provided to your questions and comments in today's session. We would like also to extend our heartfelt thanks to all our valued participants from across the Islamic finance industry and beyond for having taken part in today's public hearing on the exposure draft of this standard, and for all the regional banking supporters, like I would like to mention again here Bahrain Banking Association for their usual support of this session of these public hearing sessions. Your comments and suggestions are always essential for AYOFI in improving and fine-tuning the exposure draft for finalization by AYOFI Accounting Board for final issuance of the standard. Thank you all and see you in the upcoming future public hearings on AYOFI Financial Accounting Standards. Thank you very much. Allah bless you. Wassalamu alaikum wa rahmatullahi wa barakatuh.